Welcome to Nexgen Software Services. We're very excited to teach you how to make money day trading Fibonacci. In this section, we're going to go through stock versus futures trading, how much money you need, and some of the basics. The bar type that Nexgen Software uses, we've created ourselves. It's called a Nexgen Dynamic Renko Bar. And the only thing that you're going to really concern yourself with is, and again, we've already set up the size of the bar, but you'll see here on the input, body size equals 14 ticks, and then 2 ticks to make a new bar. Now what that means is, and you'll see pretty easily from looking at the chart, the body size of every one of the bars is exactly 14 ticks. So we have a very, very symmetrical bar. What that also means is that, again, assuming that you have an opening price to every bar, if we go 14 ticks below the opening price, we'll start making down bars. And we have an indicator that plots the price at which we will start making down bars. So again, we'll use this a lot more later, but as long as we're making up bars and we're not making down bars, we're going to look for long trades or buy signals in the market. This reversal bar marker will be 14 ticks below the low of this bar. So we'll only need 2 more ticks to make a new up bar, and we'll need 14 more ticks below this price, and you can see it's represented on our chart here, before we'll make a down bar. Now, not to confuse you too much or get too much into it, but one of the things that we will do is we will take the 14.2 reversal bar marker price, and we will superimpose that price on top of a smaller 5-1 bar. And again, on the Nexgen Dynamic Renko bar, keep in mind it's only 5 ticks now for down bars, and then all of the bodies of the bars going up are only 5 ticks. So it's a much faster chart. So, again, just to start building some terminology, what we're looking for is the large chart, the 14.2 chart, to go up, which is represented by staying above this reversal bar marker price. And then on our smaller charts, we want to have these little pullbacks where our rules are met. And again, we're not going to get into rules yet, so I don't want to get too far ahead, but pretty easy to see. If the market's going up and we don't reach this reversal bar marker, we're going to continue to do long trades. Nexgen Software, our T3 Fibs Pro Trader indicator is one of the mainstays. And what this software program will do is it will allow us to have Fibonacci analysis automated. Now, I'll give you a short little course on Fibonacci analysis, but the short version is our software will build 10 time frames of different charts in the background, and it will do all of the Fibonacci analysis for us. Now, most people are familiar with Fibonacci retracements, so they'll start at the top and they'll pull the indicator down, and you'll see that the market made a little more than a 40% retracement before the market went down, which is really nice. There's nothing wrong with that. So those are retracement type Fibonacci projections. The other type of Fibonacci projection that people use, just to kind of show you here on the chart, they will use what's called projections. And when you use an extension or a projection, you'll start at one pivot, and go to the next, and then when you pull it down to wherever the market retraced, you'll have these Fibonacci projection numbers, 100%, 138%, and so on. And essentially what you're doing when you're doing Fibonacci is you're using the prior swings in the market, which are very absolute, right? What does a swing in the market represent? The swing in the market represents the price at which nobody else was willing to sell, nobody else was willing to buy, nobody else was willing to sell. So the pivots themselves are a good representation of the overall interpretation of the market, everybody's interpretation of the market. So what our software does is it will literally do every retracement, every swing, and every projection for every swing in the market for 30 days worth of data, which really builds, hundreds, if not thousands, of Fibonacci projections. And the beauty of our software, what it will do for you, just stop moving this around for a minute, is it will take these thousands of projections and thousands of retracements, and it will just generate a red or a blue line for you. And when you have a red line, that's what we call Fibonacci resistance. And one of two things is going to happen at a red line. The market's going to reverse, or the market's going to break through. Again, the market can't stay in a range forever. So our job as we work our way through the education and the trading plan is to teach you how to recognize when one of these red lines will hold, so you can take a short position and make a bunch of money when the market goes down. Or to be able to teach you, and again, we have to get to some other pieces of our software first, when these blue lines are actually going to hold, so you can buy the market and you can make money when the market is going to go up. So everything that we will be working on going forward is to predict when one of these lines is supposed to hold, and we're going to use a couple additional indicators. And again, as we progress through, you'll see, Fibonacci areas will break. So, and that's okay. I mean, that's going to happen, and I'll get you back to this was Friday here. It's okay if they, hold or break. It's our job to figure out, if they hold, how are we going to take advantage of that? If the market bars are going up and not making down bars, how are we going to take advantage of that and trade to the upside? So we're going to use these areas as entry points. We're also going to use these Fibonacci support and not only entry areas, but as exit areas as well. And then when the market breaks Fibonacci resistance and it turns into support, when are we going to use that support to tell us to continue buying when the bars are going up? So the other component or thing that is inside of our T3 Fibs Pro Trader that we use is this little moving average. And again, it's what we call our mid-band. Without getting too tricky, it's very easy. It's a 55-period exponential moving average. And in this indicator, when it's green, we'll have the potential to buy off of that green mid-band to go up. If the mid-band is magenta, again, we haven't gone down for a couple days here, but if the mid-band is magenta, it will become resistance for us. And, again, depending on our rules and the situation, could potentially be a resistance area that we would use to sell in order to make it down to our Fibonacci support. And again, we're going to go through a lot of rules on when you can use that as an entry area and when you can't use it as an entry area, such as, the market reversed from Fibonacci support. So that's no longer going to be worthwhile in using. So we're going to go through and talk about Fibonacci areas and, the next indicator are trigger lines and how those two things will work together. There's one more small piece that we'll be doing. We have an extra indicator called our T3 Fibs Pro Trader Synthetic. And what this indicator will do, it will allow us to, on a smaller chart, such as a 5-1 dynamic Renko bar, it will allow us to plot Fibonacci support and resistance lines from other charts. So on this smaller chart, we can superimpose the 14-2 chart Fibonacci support and resistance areas. We can actually take our range bar chart, and if we wish to plot support and resistance, we can literally plot support and resistance from a bunch of different charts on top of a smaller chart. So what we end up with, and there's two trades that we will end up doing. We will do trades with the trend, and we call them trend trades. And then we will do trades at multiple time frame Fibonacci support or resistance. And that just means whenever you've got more than one line on a chart at the same spot, it starts to add power to what we do. And again, it just, I don't want to confuse you too much, but as we progress through the rules and the reading of the indicators, this is going to make a lot of sense to you. So for now, red lines are resistance, and our goal is when can we use them? Blue lines are support. When can we use them? When can we not use them? And once we put this whole trading plan together, you'll be very, very confident knowing exactly where to go short. You'll be perfectly confident knowing exactly when to go long and the reasons why. One of the things that Nexgen does is we obviously use multiple time frames on single charts. The trigger lines are no exception. So this is what your charts are going to look like. And again, just to recognize, this is a 5-1 Nexgen dynamic Renko bar. And you can see we've got our small trigger lines. That's what we call them in class. So you'll see that a lot. Small triggers, which are just the trigger lines from the 5-1 chart. And then the other triggers that you'll see, if you recall, are the 14-2 or the larger charts. Again, it just, depending on what time frame you're using, but in our case here, 14-2 small triggers, and we also call them synthetic triggers. So those two terms, if you will be interchangeable, whether we say synthetic triggers or 14-2 triggers, either way. Now, there's a couple of relationships on your chart that you're going to notice. The first of which is the background color. And the background color, when the 14-2 triggers cross over, will cross to the downside. So when they cross down, the background color paints red. Pretty easy. And then when the 14-2 triggers cross up, as you see over here, the background color will change to green. Now, what we look for is when the market is going down and our trigger lines are going down, we look for some type of short signal, or we look for our rules to be met. Now, we're not quite yet at the point where we're going to start going through rules yet. So, there's only a couple of things that I really want you to learn in this section. Number one, that we have triggers from our 14-2 chart superimposed on top of our smaller chart. We have smaller triggers on our 5-1 chart. So again, just two sets of trigger lines, one from the big chart, one from the little chart. Location, location, location. That's very, very, very important. When we start looking at our trading rules, the location of our trigger lines relative to the other trigger lines are going to be important. In the last little section, we talked about location of the trigger lines relative to our Fibonacci areas as being important. Well, if the small trigger lines are physically below the synthetic trigger lines, we have much easier, higher probability trend trade shorts. Once our small triggers get on the opposite side of our synthetic triggers, we can still do shorts if the conditions are right, but if they're not right, or say, for example, we came from Fibonacci support, then we would no longer do short trades, even though the triggers are on the wrong side. So again, there's two things that we want you to know. Number one, small triggers from the large chart and the small chart are going to be on the same chart. The background color obviously will coordinate with the direction of the larger triggers. And then location of your triggers versus the other triggers. And again, this is going to be instrumental when we get to the point of doing trend trades. Because, when they're on the correct side, trend trades are pretty easy to the short side. Where, again, when you'll see as we start working our way into the rules, when they're on the correct side, we get some pretty easy long trades. However, there are some instances where the market will be on the small triggers will physically be on the wrong side of our 14.2 triggers, and we'll still do a trade. I'm going to load for you really quickly just the trigger lines and the 14.2 reversal bar marker, so you can start to see how these things come together. Again, if the small triggers are on the correct side or not below the synthetic triggers, we'll have an easier long trade. If the small triggers get below the larger triggers, but they're still crossed up strong, we can still do another long trade, as long as, you remember, we don't take out or exceed the 14.2 reversal bar marker. Because traditionally, once you exceed that marker, and I'll draw a little circle on for you over here on the left, you'll see what happens. Our trigger lines cross up, and it really just means that your trend trade's down, the potential for a down trade once the background color changes is over. Usually that happens where that 14.2 reversal bar marker is. That's why we superimpose them. So again, as you work your way through the rules, you'll see there will be situations where you'll have trend trades where the small triggers are on the correct side of your 14.2 triggers. And then we'll also be able to do trend trades that are on the wrong side as long as we do not exceed the 14.2 reversal bar marker. And again, as we start to add in Fibonacci support and resistance areas, this will also become much more apparent to you. So again, just a reminder, correct side of the triggers looks like this. This one looks like the wrong side, but it still goes up anyway. So this is where we're going to use two rules in our trading plan to determine getting in a little earlier when they're on the correct side, or getting in a little closer to the 14.2 reversal bar marker if we're on the wrong side. One more concept, or one more little section for trigger lines, and then we'll have most of the major concepts covered. One concept that we use over and over and over again is a very strong trigger line look. And essentially, when we say the words strong trigger lines, what we're saying is strong trigger lines that are wide and up. Now, in this case, this is our 14.2 larger chart. So again, you'll get into some more videos and education that you'll see that our 14.2 chart kind of steers us in the right direction. This look right here, and again, I'm going to circle it for you, is a look where our small triggers are physically above the up synthetic triggers on this chart. So again, these synthetic triggers on the 14-2 chart come from a much larger chart. But it's the relationship of these small triggers being wide up and also having wide up synthetic triggers at the same time. These little pullbacks are the spots where we will get into trades and look for the market to continue to the upside. When you reach an area, if you've got this look, so again, I'm going to just kind of back this up just a little bit right here. I'm going to draw in a box for you right here. If you have this super strong look as you reach a Fibonacci area, very, very low chances of that area holding. Typically, we look for that area to break. Or if it is this strong, what we want to see is our small triggers cross and get below the synthetic triggers. That's kind of the first warning sign that the market's going to turn. So again, just because we have Fibonacci resistance is not a guarantee that it's going to hold. So when our trigger lines look like this, it's going to break, and we'll continue to do trades with the background color and the direction going up. As the market starts to weaken, right? So we put in our first move to the downside. It's really vitally important that you recognize that the small triggers are making a strong push below the synthetic triggers, which will bring us to our next concept. Two things are going to happen. Number one, the market will just keep going down indefinitely, which is usually not the case. The second option is if we get back to either support or a green mid-band, what we start to contend with is what we call a large gap. And you'll see this a lot on our charts, large charts and small charts. So the large gap means that you've hit a support line. And again, a green mid-band for us right here is our support line. And traditionally, what we want to do is we want to take a look at where our synthetic triggers are located. So what happens is, imagine your small triggers are a rubber band, and somebody is pulling the rubber band really far away from the synthetic triggers. Usually we'll get this snap back, if you will, at least towards the synthetic triggers, if not all the way to them and then through them. And you'll see this same exact concept. They don't have to necessarily be crossed up, even if the synthetic triggers are crossed down, as they are right here on the right edge of the chart. Where this synthetic trigger is important, and again, we're going to use this term a lot, big gap. And all it means is that the support area, which you can see hopefully now pretty easily down here, blue Fibonacci support, and then the distance from the small triggers and that support back to the synthetic triggers creates a big gap. And what this big gap will do is it will start to give us the ability to predict that this Fibonacci area will hold. So again, we're using, a couple of things. Number one, and I want you to look almost at this same area to the left, the beginning of the chart. If the triggers are super, super, super strong and going up, we almost always break whatever area we come across. If the triggers remain strong and wide to the upside, we'll continue to do long trades or buy signals as long as the market and the triggers remain strong and we haven't reached a target. As the market starts to weaken, you'll be able to physically see the weakening, or the first time where our small triggers get below the synthetic triggers. And usually we get one more bounce up to retest, from a support or a mid-band. And, if we fail to get back above the synthetic triggers again, which we failed here, the market will traditionally start trading back down to the downside. So again, if we were long, we would watch our positions. And if we had reasons to go short, let's say here on our smaller chart, we may start taking short trades, because the location of our small triggers is on the wrong side of or below our synthetic triggers. Then as we reach support, we have to evaluate again. Where are the small triggers? Yes, they're pretty strong down into the area. However, that is trumped by the fact that we have this big gap. And this is really the outcome of what we're looking for when we have a big gap. And then, again, we go right back to the same thought process. Trigger line location is above right? So if our synthetic triggers are violated by the small triggers in price, as we pull back again to support areas, green midbands, Fibonacci areas, we start to build a case for the market to go back up and to reach our next Fibonacci resistance, which again, this would have been our target area. And again, you can see this is another case of strong trigger lines going up into a Fibonacci resistance. And again, this happens a lot when they're strong. Resistance will break. We'll look forward to opportunities right here where we can actually take long positions on pullbacks to the support. And, if all goes well, the market will continue to the upside. So again, just a short recap. If the triggers are super strong heading into a resistance, don't try to go the other way. Wait for it to break or roll. If they remain strong, just keep remembering trend trade long or short, depending on direction. Once the small triggers make a sharp move, right, below these synthetic triggers, again, you're going to bounce. Obviously, the bigger the gap, the bigger the bounce. And then when we use this same logic, as we're looking at either mid-bands holding or Fibonacci areas holding, location of triggers versus the triggers is important, and location of triggers versus our Fibonacci areas, as you've already seen, are very important. Again, to review, if you look over here at the left side of my chart, I'm going to draw a circle. This is the concept of very strong trigger lines going to the upside. Now, initially in this very first circle, what do you see? You see Fibonacci resistance, and it starts off with none of the trigger lines breaking through the Fibonacci area. So there's two reads that we have at our Fibonacci area here. The first read is that our trigger lines did not break above Fibonacci. Right, so obviously we had, and again, I don't want to go too far back, but I think it's pretty easy to see that when your triggers break above a Fibonacci area, we're going to continue to look for long trades. And if the trigger lines move up again, and we will continue to again look for pullbacks for long trades. And eventually we're going to hit a Fibonacci resistance. Here, I'll put a box on it for you. And we have to, obviously that's probably your profit target, but we have to determine if we want to go short at that area or not. And remember what I said in the last section, if your small triggers are going up strong and your synthetic triggers are going up strong, you will traditionally break above the resistance. And you can see, this was from Thursday, I guess. You can see the market goes up to the next resistance. And again, the market will break resistances. Sometimes you get a really strong trending market, and you have to recognize this look of being very strong triggers. Don't go against it. Now, per our last section, the first time that the small triggers weaken or get below the synthetic triggers, you can see what happens. We get one more final run to the upside. And again, this weakening of the small triggers finally says that because the fibs were not violated by the trigger lines, and we had the small triggers get below the synthetic triggers, then this usually will, this will end up being your last long attempt. And sometimes you don't even take that last long attempt. But again, you have to recognize the location of your triggers relative to your fibs. And, again, this is one of those big gaps back to the synthetic triggers, right? So, again, you'll start recognizing these as time progresses. Now, I want to introduce another concept that happens a lot at Fibonacci areas. It's what we call a pivot stop out. So if you take this yellow box that we're looking at right here, a lot of times when the triggers don't break through, the market will come back up and go just a little bit beyond that high, and then it will reverse very, very quickly. And you're going to use this literally every day, sometimes 4 or 5 times a day. So pivot stop out is what we like to call it. And it just means that price went higher than the last pivot, right? So for people who went short here, this is usually a stop run and then a reversal. So again, if you barely violate the last pivot and the last pivot said that the resistance should hold, you'll start to end up with a better thought process that you might be at a potential top. Now I want to reintroduce one of the slides that we looked at a lot earlier when we were looking at our fibs and trigger lines, small trigger lines only. Initially, if you're at a Fibonacci area and you're starting to anticipate that it might hold, but the small triggers violate above it, we have to wait for one of two things to happen. Either the Fibonacci area to turn from red to blue, in which case it's broken and we'll keep trading with the trend, or the small triggers physically get back below the resistance. Remember this one? Then we can actually use the resistance to go the other way. So when we look at this chart, just a quick little review, you'll see the pivot stop out number 1. However, we can't necessarily go short up here. However, when the small triggers get back below the fibs and the synthetic triggers, this spot becomes the exact spot where we look to initiate the first short position against the trend. So again, it's, this is really, really typical of what happens almost every day. Strong triggers break fibs, strong triggers break fibs, strong triggers finally don't break the fibs. Then you get one more last attempt, as long as you don't start making down bars past your 14-2 reversal bar marker, remember. And then after a pivot stop out or a retest of resistance, we wait for the trigger lines to get on the correct side, and then we'll end up taking short trades. And then as we scroll forward, you'll start to see, obviously, the market trades down into support. And you'll see that, even though we're at support, the trigger lines physically got below the support, which is very important. So when we pull back and we retest the triggers that have crossed down for the first time, we're going to be looking for some type of a short or going down trade over in this area. And again, you'll see the background color really helps with this. And, as this progresses, you'll see the market goes down and hopefully, obviously making some money. And, the same thing holds true. Then we get back into the same type of reading that we were doing before, which is what? If the small triggers are below the synthetic triggers, right? So you can start to see how we piece together our trade setups. Small triggers physically below, we're going to continue to look for more short trades. And, this same look as we start to get into trade management will mean that, when the triggers are going down, the synthetic triggers, and the small triggers are below, we almost always make it to our Fibonacci target. So again, it's imperative to read, not only your fibs and triggers, but your trigger line location, and that will help you as we start to work our way into trade management on what's going to happen next. In continuing to look at the indicators that will be in our trading plan, down at the bottom, you'll see our fib to fib oscillator. And again, this is a proprietary oscillator that we've put together that will help us to determine when we've had enough of a pullback to take a trend trade. So again, there's multiple layers that we're adding in here. The short version is, and the rules for a trend trade long is that we want this oscillator to either be at 25 or 0. We want it to be in the lower 25% for a buy signal. So what we end up with and what the trade would be in this situation is, again, reading your fibs and triggers, you can see that the trigger lines have broken through Fibonacci resistance and that the trigger lines are going up strong. And then the market makes a retracement. And again, during this retracement, you'll see that our fib to fib oscillator satisfies the thought process for being in the lower 25%, which will help us to pick the right spot from which to go long. And again, one of the things that, we talk about is Fibonacci areas breaking. Again, when the triggers are very wide, synthetic triggers, very wide and very strong, we're going to go to the next fib. And usually when we go to the next fib, then we, again, read our fibs and triggers, and you can see, obviously, the market's going to continue to go up. So as long as the trigger lines are very favorable, and again, we'll just do a little bit of reading here. Trigger lines going up strong and breaking through resistance and price pulling back to support and the fib to fib oscillator pulling back to the 25 buy line, it's going to enable us to do two things. To recognize that our small triggers are not below the synthetic triggers, which means we need to look at the first area of support for going long instead of the last. And number two, more importantly, we know where the next target is. The next target's at our next Fibonacci resistance area. And again, as time progresses and we work through, the market going up and then the market changing direction, and again, you'll start to see, again, I don't have every indicator on here yet, but you'll start to see the opposite happen. So, you'll start to recognize the weakening of your triggers and your trend and the trigger line starting to pinch over. And you'll see, another pattern that happens a lot in our fib to fib oscillator, which is a sharp point. And all that really means is that the fib to fib oscillator was at 100 or 75 for only one bar. And it makes, what very visibly looks like a sharp point on your oscillator. Now, by itself, not very powerful. When you add to the idea that you have a sharp point on your fib to fib oscillator and you're at Fibonacci resistance and the small triggers have gotten below the synthetic triggers, and you put it all together, you start to anticipate that this area may potentially be a top for you. Now, again, you remember the picture that, again, we refer to this picture quite a bit. You'll see what? Strong triggers breaking or strong triggers into resistance. And then after the triggers get back down below the resistance works. Well, when that happens, so again, you can kind of see that process over here. Strong small triggers into resistance the first time. The second time we hit resistance, again, this is just trigger line reading. Look at where your small triggers are. Your small triggers are considerably lower than they were the first time when they were strong into the area. this area becomes a higher probability area for the market to reverse. So again, we've got multiple layers working for us at this Fibonacci resistance. Lower small triggers, which is good. Small triggers below our synthetic triggers, which is good. And then the other thing that you'll notice is that even though price almost makes, an equal high at the top, the Fib to Fib oscillator has a lower low. So we have the potential for, really a divergence between the price and the Fib to Fib oscillator. So this will help to add, again, confidence at an area. Number one, you had a sharp point. Number two, the small triggers are below the synthetic triggers. Number three, you have lower highs on your Fib to Fib oscillator, and we end up with a potential top. Now again, starting off, you're going to probably start with trend trades and with the background color of the chart, which is fine. We're going to use the Fib to Fib oscillator in that scenario as well. So the same way we use the Fib to Fib oscillator in the lower 25% for long trades, we're going to use the Fib to Fib oscillator in the upper 25% for short trades to help us define when and where we can start looking for a potential trade with the background color, with the small triggers below the synthetic triggers, with the Fib to Fib oscillator at the 75 or 100 upper 25%. And then you'll see what happens. The market goes down and we pull back for yet again another potential short trade. And you'll see that not only do we have our small triggers inside or below the synthetic triggers, we have Fibonacci resistance, and we have our mid-band, which again, part of our rules is determining where we're going to get short. And then the final piece of our rules are Fib to Fib oscillator in the upper 25%. So it creates a very, very strong, very high probability trade. And then as you progress forward, you'll start to see, the opposite. Once we get above, or the trigger lines get above our synthetic triggers, if the market fails to get back below the synthetic triggers, if for some reason you were still short, you'll recognize the sharp point on your Fib to Fib oscillator at the 25 buy line this time. So it's kind of the opposite pattern of what we had over here at the top, where we had lower highs. And now over here, we've got higher triggers. Look at the small triggers relative to each other. You'll see that pattern a lot. And we have a sharp point on our Fib to Fib oscillator. Traditionally, that's going to cause the market to reverse and at least get to a higher area, if not, really turn the trend all the way around. The final indicator that you're going to see on all of our charts, and you're going to see a lot of it, is what we call our T3 divergence potential. And it's going to plot these negative numbers on your chart, and it's going to be responsible for plotting either cyan on the bottom or magenta dotted lines on the top. And what this indicator is based on, and you have to keep in mind, obviously, with Nexgen being over 20 years old, one of the things that we did way back in the day was look for divergence at Fibonacci resistance. And again, divergence is pretty simple. It just means that whatever indicator you're looking at was lower at a time when price actually went higher. So, and again, it's kind of a measurement, if you will, of the difference between how much percent retracement was here versus how much was here. So what you'll end up with is, and again, you don't have to really know much about the indicator itself. What you really need to know is what to do with the indicator that's on your chart. And again, once we reach Fibonacci resistance, we're going to have a combination of a lot of different factors. We're going to have, first of all, reading our trigger lines. Did the trigger lines break through the Fibonacci resistance? And the answer is no. However, our synthetic triggers are up strong. So we're probably going to get one more push back to the upside. Now, because the triggers and the price didn't break the fib, and we had this negative number 38 divergence. And again, don't worry about the size of the number. Any negative number is a divergence, and it'll plot for you, so you don't really have to worry about figuring it out too much. If there's a negative number and there's a pivot, it's going to draw this magenta dotted line. Now, this adds power to this area. It means that initially we had resistance, and initially the triggers didn't break through. So remember the concept that we introduced just a little while ago, a pivot stop out. Now this adds power to, our ability to go counter trend trading. Obviously, our traditional trend trade is long when all the triggers are going up. Now, once we reach a key area, and you'll see we've had a prior divergence and none of our trigger lines have broken through, now we can incorporate that same thought process on a pivot stop out. So we have a pivot stop out of Fibonacci areas, right? And prior divergence highs as marked by the magenta dotted line going sideways. So at this very moment, right here, we really, really, really have a high probability of the market going to the downside. And again, you'll start to see as we work our way through our trading plan, if you've got negative numbers of divergence on not just your 14-2 chart, but your 5-1 chart and your entry chart with the market flow, then you really start to build the thought process of this area is going to be an absolute. It's, if it breaks and turns blue, sure, we'll keep going long. If not, we're going to use, the multiple lines in the same area. Sometimes it's 2 or 3 Fibonacci areas in the same area. We're going to use prior divergence highs and lows as entry spots. Obviously, if we're at a spot for going short. And the other thing that we'll be able to use it for, and as I kind of back out just a little bit, you'll see down here at the bottom left, we had a divergence low, right? So again, you start to see all the concepts coming together. We had a big gap back down to the synthetic triggers that got filled, and a divergence low, and the market went back up from that spot. And again, the market goes up and the small triggers are above our synthetic triggers, and we hit green mid bands and we look for long trades until we get to resistance. Once we reach resistance with divergence, we have to wonder, is the party over? Now the market does go back up, and again, it's on this retest of a divergence high as dedicated by the magenta line. With more divergence working, this is where we really, really, really excel at counter trend trading and going short. Now, if you recognize, these as significant pivots, you'll see over here, the market literally went up almost $700 a contract from this last divergence low. So you'll see the same concept over here. This would be a fantastic target, right? So what happens is if you went short and you reached a prior divergence low, you can also use that line as a profit target. So in expecting, again, you can see it's really a pivot stop out of that last low just by a little bit, and then it bounces up. Now, of course, it bounces up, but you're going to be really good at reading your trigger lines now at this point. So you're going to recognize that your synthetic triggers are down, and you're going to recognize that your small triggers are way below them. And you're going to start thinking about, hey, where can I start taking the next trend trade short? Because we can read not only our fibs and triggers, but now we've got divergences to help us out. And you can see as we reach that mid-band resistance with the potential for divergence, the idea is that we're going to make it down to Fibonacci support. And again, as we trade down into Fibonacci support, you'll start to recognize that if you've got negative numbers working going into support and the trigger line's not really breaking through, that support traditionally is going to start holding for us. So again, you'll start to, really work through the process of seeing where your triggers are relative to the other triggers, right? Small versus the synthetics. Then when you reach Fibonacci areas, you'll start to recognize, the trigger lines didn't break through the fibs and we have divergence. Then you'll recognize pivot stop outs at the edges at Fibonacci resistance for the first attempt to go the other way. And then you'll recognize, again, the trend is down and the synthetic triggers are down and the small triggers are below, so resistance areas hold and take us down to support. And then you'll finally get to support and you'll recognize, again, the potential for divergence and the fact that none of your trigger lines broke through support. So that's a really good opportunity for, the thought process of maybe starting to think that the trend's going to go the other way. And you can see obviously it does with, and this is from Thursday, so I'm making this on Sunday. So you can see this is really what we deal with on a day-to-day basis. And the more time you spend with this, the more comfortable you'll be. Look at what happened over here. We got back to resistance. Well, it's the same exact resistance as over here. Over here, we had divergence and divergence pivot stop outs. At the resistance this time, you remember that really strong look of your trigger lines? And you know what happens when you get that really strong look. The Fibonacci area usually breaks. So again, just, there's multiple tools that we use, right? And we also have a synthetic version, so we can plot these major lines from our 14-2 chart right on our 5-1 chart. So not only will we have divergence and Fibonacci areas from our big chart superimposed on our little chart, we'll have the triggers and we'll have really a complete package. When we look at both of these charts, we'll be able to know exactly when to get in, when to get out, when to stop trading in a long direction, when to start trading, short, and when to start trading long again. And finally, the last indicator that you're going to see a lot of is our T3 market flow indicator. And the short version is this is part of our trading plan right here. The market flow indicator and the market flow automated entry helps you time your entries at areas. Again, I want you to keep in mind and I want you to understand the thought process. When we look at our larger charts, and this is really the full package right here, you end up with these Nexgen dynamic Renko bars smoothing out price, which gives us a very clear, very broad view of whether we're going up or whether we're going down. So we use the large chart to say, hey, we're going down, and we're probably going down to Fibonacci support at 62.34. Then we're going to go in and we're going to look at our 5-1 chart, our smaller chart. And, again, whenever you're about to place a trade, you have to, what? Read your fibs, read your triggers, and obviously we have a lot of rules inside the plan for when and where we're going to do that. But it should be pretty obvious that, somewhere around this area is where we'll start thinking about short trades. And once we actually have the rules met for a trade, and again, this is, the market flow should, for all intents and purposes, be ignored unless we have fibs that are supposed to hold for sure based on our trigger line and divergence reading, or we have a very strong trend with an entry area. And then what we'll do is we're going to look at our market flow. Now, there's a couple of different patterns that happen in the market flow that we use a lot for entries. So what we call antenna looks, essentially what it is these two little black lines are representative of high volume areas inside of the bar. And what happens is with the range bars, and again, remember we're using a 5-range chart to help us pinpoint our entries. When we're looking to go short, we can have this bar structure happen and then we'll take a short position. If we were to anticipate a long trade from Fibonacci support, the same look, these two little black lines are the high volume area, the bar goes down and then it reverses to the upside, that would be a long signal for us. So again, it's literally just the bar structure itself, and for really lack of a better descriptor, it looks like a TV antenna. Now, one of the other paint bars that you're going to see is a white paint bar with multiple dots. So green dots represent more buyers in a bar at a particular price. Magenta dots represent more sellers at a particular price. And the white paint bars are used to denote a volume breakout to the upside. So you can see right here where we have the white paint bar, we have more volume going up and breaking out from prior bars. So it's just a warning that, potentially the market could go up. Same thing over here. Obviously, we have a lot of Fibonacci resistance, but this is where the volume really shifts to the downside. And again, what we're trying to do is we're trying to determine which Fibonacci areas are going to hold or break based on triggers and divergences. Then we go to our trading rules. And then once the rules are met, then we look for a market flow pattern. One of the other patterns, again, that we'll use, and you'll see this, you'll get a white paint bar down, but it will be into an area that may be going up. So if you get a white paint bar down with magenta dots, and the next bar is a reversal bar to the upside, that will be a long signal for us. And then again, you'll see as we reach the edge of Fibonacci resistance, we have an antenna bar, which takes us back down again. And then as we pull back into Fibonacci resistance with all of our trigger lines going down, you'll see we have a white paint bar up, but it's not really a long signal. It's the next bar down will end up being a short signal for us. And then the final pattern that you'll see is a yellow paint bar inside the market flow. And the yellow paint bars are pretty simple. It just means that you had a volume reversal, which means nothing more than you had, let's just say, a couple magenta dots going down, followed by a couple green dots going up. Now, obviously, if you're at Fibonacci support and the triggers haven't broken through and you have divergence, this bar is going to be an entry signal for us. So again, when you're entering the market, and again, as you start working your way through the trading plan and, again, start working your way through the rules, we'll just take a quick peek at the rules and then we'll go look at a chart. The trading rules for trend trades are pretty simple. We want the large chart to be helping us, strong triggers helping us. We want the smaller chart to pull back to fibs and mid bands and have the triggers in the right direction. We want the fib to fib oscillator to be right. Then we're going to go through a check of where are the small triggers in relationship to the synthetic triggers, as you've already seen. And then we're going to say, again, what type of move will we do a second trade? What type of move will stop doing trades? And then, again, always making sure trigger line location is our top priority. Once you work through understanding the rules and when and where to get in and out, then we'll start working on management. And the management of trades, once you read your fibs and triggers and divergences correctly, will become pretty easy. If the market looks like this, for example, this is what we're looking at. This is a high probability look that Fibonacci resistance is going to hold. And again, it's predicated or based on what? Small triggers are down really strong below the down strong synthetic triggers, which, again, that look breaks fibs. So once fibs break, we'll anticipate that they are going to hold and we can start doing short trades. So until you get an actual trade setup, you don't even look at this chart, which is our market flow chart. But the market flow strategy itself has a couple of different options. And again, you can see the same fibs and triggers superimposed on here, but it's obviously a different bar. So you have a couple of choices with the market flow. You can wait for it to get to the spot where you're anticipating a trade to happen from. And then when you get to the spot, all you do is turn on these two sell buttons. And again, you have to, I predicate this with you have to know what the right spot is by reading your fibs and triggers. So again, the trading portion of what we do doesn't really come into play until you've studied reading your fibs and reading your triggers and understanding the rules and knowing where and when it's appropriate to turn on the strategy and wait for an entry. There is a second option which is available to you, which, again, this is, there's a certain situation where, we may want to just place an order directly at the spot where we want to go short, or maybe a tick below it or so. And, this would be a situation where only when we have very, very, very strong trigger lines in very strong areas and no divergence prior to that would we have the opportunity to be able to allow the system to just, or place an order at a spot and allow the system to get us into a position. So again, you can see pretty clearly that, 58 is our Fibonacci resistance right here. So again, two options for entry. Number one, you can just get in at the spot. Or number two, when you hit the spot, you just turn on the market flow like this, and then you wait for the reversal bar. And what will happen after you get the reversal bar is you'll be able to, it'll automatically get you into the position. The perfect look with our triggers. Let me show it on this chart. You can see this is a really perfect look for us for going short. So, again, there's a couple of places where you will be in at the spot a little bit more assertively. And then as the trade progresses, once we start getting down bars, we're going to teach you how to manage your position and actually take your stop. And, really you're going to risk no more than the upper part of the reversal bar. So once you get a bar down on your big chart or 5-1 chart, you're able to reduce your risk significantly. And, again, the target obviously is for us to be able to make it down to Fibonacci support. So as the market works its way down towards Fibonacci support, these are the times where, again, reading your fibs and reading your triggers becomes very, very handy. Because once we reach multiple time frame support, as we showed you, one of the things that we're going to do is we're going to watch for potential divergence. Remember that? So if we have the potential for divergence, we, obviously don't want to stay in that position much longer. So if the divergence actually happens, right, which would be signaled by what? It would be signaled by this bar actually making an up bar. And you can see we've got this reversal bar marker for our 14-2 chart. 62.61 over here, 62.61 over here. So again, we might think about the potential of, if we hadn't already hit fibs, maybe a pivot stop out. You can see our divergence lines, maybe another short trade. If the market had gone up to here and then back down again, which it didn't. It actually went from resistance down to support. So with potential divergence, and, as we work our way forward through this, you'll see we end up with actual divergence that will happen on our chart. And these are the things that we'll be doing, in class, and you guys will be doing on replay, and you'll learn through practice and replay and participation in the class where to get in, when to get in, why to get in, how to get in. And you can see, obviously a significant number of blue Fibonacci lines down here. And, you can see initially the triggers are down strong, so we're not going long here. Really where we would think about the potential of going long is, again, if we retested this area a second time with divergence potential, then we'd have a much better chance of this low actually holding and generating long trades for us. So you can see if you allow the, again, all I did was wait for a retest of a divergence low with Fibonacci support and allow the automated market flow system to just generate a signal for me. And again, when you, get comfortable trading from the edges, you end up with, again, very small stops. And, again, if the market makes it back up to Fibonacci resistance, which is always target areas for us, right? I'll just leave that alone. Then you end up with, the ability to manage and, obviously get your risk up here. But you'll see, on a day-to-day basis from what we do, 2 trades. And, this is a perfect representation of both of our trades. One of them is going to be a trend trade with everything going in your favor, which I think is pretty easy to see. And then the second trade that you're going to end up doing is going to be a counter trend trade from multiple time frame fibs, from divergence, and really be able to take advantage of the market going either way. So when we go back and look at, the real world here. So this was the look of our large chart when we were doing short trades. And this, obviously, is the look of our large chart when we start thinking about doing long trades. And already you're saying to yourself, hey, wait a minute. That was a big gap back to the synthetic triggers. Right? So you're able to start reading the fibs and reading the triggers and saying this, 3 or 4 time frames of blue Fibonacci support with this large gap really creates a high probability long trade. Then you add to that the fact that we had divergence at the bottom at the fibs first, and then we had a second divergence at the fibs, and the small triggers were higher. And you remember, fib to fib oscillator was also higher. You start building the case for a very, very successful counter trend trade from the multiple time frame fibs. Literally, this is it. This is what you will be doing every day. Trading with the trend, 2 Fibonacci supports and resistances, when the support and resistance say it's going to hold, you'll do counter trend trades going back the other way. And ultimately, in the end, our objective for you guys is to be able to make $400 per contract or $800 per two, or, again, as you guys will see in the trading plan, this is really our goal and objective for you. $400 per contract per day, which is a very realistic expectation. Once you can do this consistently on one market, then you can work your way into more contracts. And obviously, if you're trading, two contracts and making 400 a day, you're going to make more money. If you make 400 a day and you trade 10 contracts, over the course of 20 trading days, you're going to make $80,000. Again, I don't want you to get too far ahead, because before you ever trade any live money, you've got to really go through in our plan, and you've got to perfect, these things. Let me go to the last page here for you. You've got to really, really get good at recognizing the right setups, right? So you have to know when the triggers and when the fibs and when the areas are going to hold and what the rules are. Then you have to fine-tune your entry execution, and then you have to fine-tune your management of the trade, which we cover all of this in the trading plan. And then finally, you're going to practice the rules on a simulator, and you're going to do it over and over and over and over again until it becomes second nature to you. Once you have done that, then you've really earned the right to make real money. So again, our objective for you guys is to get to this spot right here, to be able to make 400 a day per contract, to never risk more than or attempt at least to risk more than $100 on any one trade. So most of our trades average about $60 risk. We're going to get you to the point where you're 100% self-sufficient and responsible for your own trades. You've proven through your own practice and your own simulation and your own real-world experience that the trades work and make money. And most importantly, we're going to make sure that you're 100% comfortable with your trades. You know what to do, when to do, how to do it. And, finally, the final piece to the puzzle is going to be logging into our trading room. So when you log into the educational room, your salesperson should send you out the password to this. In this room, I'm going to actually broadcast my charts. We're going to talk about trade setups. We're going to do lessons live. You're going to have the ability to post in pictures of your trades and your setups and your management, and ask questions and get feedback, and really just make sure that you have done everything that you needed to do according to the trading plan. So let's get to work. If you haven't yet, filled out a demo form, fill out a demo. We'll get you software. We'll get you everything that you need to be successful. We'll get you into our class. And bottom line, we'll get you involved in the markets, doing very confident trades with the trend and even more confident trades against the trend, and reaching your goals and objectives. Look forward to seeing everybody soon. Have a great day.